Good morning, students. Welcome you all once again in the second and the last lecture of India's 36 Impairment of Assets. In the last class, students, we have discussed on impairment of assets, few concepts on impairment of assets, and I have started with the difference between depreciation and impairment, right? Because impairment is something which is there on tangible kind of assets, which is covered under this particular standard, like tangible assets, like intangible assets, like investment property, right? So before impairment, there could be implication of depreciation on these kind of assets. So what is the difference between depreciation and impairment? We have discussed in the last class that depreciation is kind of a regular item in nature. Impairment is kind of extra hit in the P&L, which is over and above depreciation. Depreciation is a systematic charge, whereas impairment is kind of a one-off. Depreciation is on a consumption based, whereas impairment is on the event based. Like we have taken an example of a car. There was a diesel car, and government has come up with an announcement for banning this diesel car 6 months down the line or 1 years down the line. Just due to this announcement, the price of the car will go down, the market value of the car will go down, the recoverable value of the car will go down. Although there will not be any impact as far as consumption of future economic benefit is concerned, right? The features of the car, the productivity of the car will be as it is. Okay, and depreciation is a kind of a thing which comes first and impairment comes later on, right? As far as agenda is concerned, we have discussed that what is the objective of this standard, what is the scope of this standard, and what is the meaning of impairment loss, and which assets may be identified which can be impaired, right? So how we can identify an asset that may be impaired? And I have told you that impairment testing exercise is a costly exercise as well as a time consuming exercise. So at the end of every year, you are not required to do the impairment testing of all the assets, right? Except three assets. There are three exceptions which I have discussed with all of you. Except those three exceptions, you know, other assets is required to be impaired only when there is an indication of impairment. Then we have discussed how to measure the recoverable amount, because the objective is your asset in the balance sheet should not be more than whatever recoverable amount is there, so that it will reflect a true and fair picture for the user of the financial statement. So measurement of recoverable amount is again very important thing in this standard, and we have discussed that recoverable amount is higher of fair value less cost to sale and value in use. Then we have discussed recognition and measurement of impairment loss, how to recognize and how to measure impairment loss, right? So impairment loss is a difference between carrying value and recoverable value. And of course, when carrying value is greater than the recoverable value, then there is a need for impairment. If the carrying value is already lower than the recoverable value, then there is no impairment, right? In that case, if the company has opted for revaluation model, in that case, the company has to go to the upward revaluation. Then there is a concept of cash generating unit, which is nothing, it's a group of assets, because impairment exercise has to happen on an individual asset as well as group of assets, right? Then we will discuss the concept of goodwill here and the concept of corporate assets. Then we will discuss how to allocate the impairment loss in the cash generating unit, or how this corporate asset has to be impaired, and when impairment loss can be reversed. We will discuss this aspect also, right? Objective, we have discussed that this asset ensure that the asset should not carried at more than the recoverable amount. This standard defines what is recoverable amount. This standard provides how to allocate and when to reverse impairment loss, and this standard also provide disclosure. Ind AS 36 applies to all assets except inventories, because if you are reducing the value of the inventory because of cost or NRV, whichever is lower, it is due to Ind AS 2, it is not due to Ind AS 36. So at times in the office or when you are doing an audit, so people will say that inventory has been impaired, right? So although inventory has been impaired because the value has gone down, but it does not mean that the impairment of inventory will be covered under Ind AS 36. It will be covered under Ind AS 2, right? Contract assets and contract assets and assets arising from cost to obtain or fulfilling a contract under Ind AS 115. So this kind of contract assets is also covered under Ind AS 115 and not covered under Ind AS 36. Deferred tax asset, for example, you have recognized a deferred tax asset. Tomorrow you don't have any visibility of future profits, so you have to de-recognize deferred tax asset. You have to reduce the value of the deferred tax asset. So this is again, this impairment of deferred tax asset is not due to Ind AS 36, it is due to Ind AS 12. If the value of the plan assets are decreasing, in that case, it will be covered under Ind AS 19, not Ind AS 36, right? Biological assets measured at fair value less cost to sale. You have recognized a biological asset at fair value less cost to sale. In the subsequent period, the fair value has gone down, or let's say cost to sell has been increased. So in that case, if there is an impairment, that impairment is due to Ind AS 41, not due to Ind AS 36. If there is any impairment on insurance contracts, right? So on those insurance contracts, the impairment has to be taken care as per Ind AS 104, not as per Ind AS 36. If there is a non-current asset classified as held for sale, for example, there is a building and the company has classified the building as held for sale due to the cash crunch or due to the need of money. So that building has to be recognized at cost or carrying value or fair value less cost to sell, whichever is lower. So if there is an impairment due to classification of asset as held for sale, that impairment is according to Ind AS 105, not according to Ind AS 36. Financial assets. You have the financial assets and you have recognized financial assets and you are doing mark to market. You are doing fair valuation of the financial assets, right? If the fair value is decreasing, this decrease is not as per Ind AS 36. This decrease is as per Ind AS 109. Okay. So friends, we have discussed that impairment loss is the difference between carrying value and recoverable value. For example, the carrying value is 37,000. The recoverable value is 30,000. So there is an impairment loss of 7,000, right? So we have discussed that recoverable amount is higher of, it is higher of fair value less cost to sale and value in use. For example, fair value less cost to sale is 10 lakh rupees. Value in use is 8 lakh rupees. So recoverable amount is always 10 lakh rupees, right? Fair value is something which is a market driven value. It is a market value. Value in use is something which is a present value of future cash flows. So value in use is an entity specific value. If I talk about value in use, it is an entity specific value, right? This value in use is an entity specific value. And if I talk about this fair value less cost to sell, it is a market kind of, it is a market value, entity specific value. And fair value less cost to sell is a market value, market driven value or market value, right? Then we have done this small case study. Then we have jumped on the next concept, identification of an asset that may be impaired. So an entity shall assess at the end of each reporting period, at the end of each reporting period, at the end of every year end, whether there is any indication that an asset may be impaired. So you are not required to do the impairment testing exercise. You have to see, is there any impairment? If impairment is there, then you have to go for the detailed impairment exercise. And what is the detailed impairment exercise? The detailed impairment exercise is identification of recoverable amount. So you must be wondering, sir, this is very simple thing. Identification of recoverable amount, guys, this is not a very simple thing, because if you have to estimate the recoverable amount, you have to value your fair value less cost to sell. So you have to estimate what is the fair value. Probably for estimating the fair value, you have to engage the valuation team as well, right? And you have to estimate what is my cost to sell. You have to take the quotation from different vendors, right? So it is a cost compulsive exercise as well. Second, you have to compute your value in use. So for computation of value in use, you have to predict, you have to estimate your future cash flows, right? You have to do a lot of calculations and you have to estimate future cash flows. And while estimating future cash flows, you have to take into consideration various aspects of it. What is there in the cash flow? What is not there in the cash flow, right? So you have to do all these exercises as well. Once you estimate future cash flow, then you need to discount those future cash flows, right? So in that case, you have to estimate the discount rate as well. And what is the discount rate? The discount rate is weighted average cost of capital, which you must have learned in MAFA, financial management, right? So this weighted average cost of capital is generally available for listed companies. If weighted average cost of capital is not available, then you have to go for the incremental borrowing rate of the company. If the company goes into market for taking a loan for, let's say, 5 years or 10 years, what is the interest rate? the bank will give to that to this company, right? So we have discussed this aspect, and we have discussed that there are three kind of assets. There is an exception. I have told you that first you need to see, is there any indicator of impairment? If the indicator of impairment is there, then only you have to go for detailed impairment exercise for calculating recoverable value. But there are three assets where you are not required to wait for the impairment indicators, but you have to perform the impairment testing exercise at least annually, at least once in a year. And which are those three kind of assets, Srinidhi? Which are those three kind of assets? These three are intangible assets, and these three are intangible assets. Intangible asset with an indefinite useful life, which you have learned in Ind AS 38. Intangible asset not yet available for use, goodwill acquired in a business combination. These three intangible assets, if these three intangible assets are there, then these intangible assets are required to be went through an impairment process at least once in annually, at least once in a year, right? And while discussing this, we have also discussed that in these kind of assets, first, impairment exercise should be once in a year. Second, if these three intangible assets have been developed or acquired during the year, so it doesn't matter if it is in quarter 4 of the year, still the impairment testing has to happen. Sir, whether impairment testing is mandatory at the end of every year? Answer is no. Impairment testing has to be there once in a year. For example, if you are performing an impairment testing in quarter 2, so the consistency should be there. In the next year, you have to perform in quarter 2 as well, right? Because if you have performed in quarter 2, or let's say you have performed in quarter 4, and now you will in the next year perform in quarter 1, so probably there is no difference in quarter 4 and quarter 1, because the time is very limited or the time is very shorter, right? So this three aspect was there as far as impairment of assets on these three assets are concerned. So we have discussed indication of impairment, and we have discussed there are internal indicators and external indicators. The example of internal indicators is evidence of obsolescence or physical damage, the asset remaining idle, discontinuance, disposal or restructuring plans, declining asset performance, right? External indicator is beyond the company, beyond the premises of the company, like significant decline in market value. And I have taken an example of my S9 Plus phone, right? When I purchased that phone, the price was 65 to 70,000, and after 1 year the price came down to 35,000, right, at Flipkart. Changes in technological, market, economic or legal environment. Due to the change in techno, market, economic or legal environment, there could be a this is again an indicator of impairment if it is a negative changes, right? Changes in interest rate. When I say change in interest rate, I mean to say when increase in interest rate. If there is an inflation, if the interest rate is increasing, in that case you are required to, it is an indicator of impairment. You are required to calculate value in use, because higher the interest rate, your value in use will go down, right? Low market capitalization. If the market capitalization of the company is getting lower, for example, Paytm, when the IPO of Paytm came, so the price was close to 2200 or 2100, but now it is running at 650 or 700 odd number, right? So there could be a low market capitalization, which is again an indicator of impairment. I'm not saying if there is an indicator of impairment, there will always be impairment. I'm not saying that. But if there is an indicator of impairment, you have to perform the impairment exercise. While discussing recoverable amount, we have discussed that recoverable amount is higher of fair value less cost to sale, and value in use, since it is higher. So if you have calculated any one leg, for example, you have calculated fair value less cost to sale, and the fair value less cost to sale is higher than carrying value. In that case, you are not required to calculate value in use, because you have to take higher. Even though if the value in use will be lower, still you have to consider the higher value, which is already higher than your carrying value, right? So if one leg is higher than carrying value, then you are not required to waste your time and money in calculating the another leg, right? Then we have discussed the meaning of fair value less cost to disposal, and we have discussed the fair value definition is as per Ind AS 113. You are not required to remember this definition. This definition is as per Ind AS 113. Fair value is a price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Cost of disposal is an incremental cost. So cost of disposal, it is an incremental cost. If the decision of sale would not have been in place, if the decision of sale has not been taken, then this cost of disposal will not arise, right? So cost of disposal is an incremental cost directly attributable to the disposal of an asset or cash generating unit. So in this entire standard talks about individual asset as well as group of assets, right? Excluding finance cost and income tax expense. In the cost of disposal, finance cost and income tax expense is not required to be considered, right? But otherwise, once you have taken a decision to sell, after that, whatever incremental cost is there, whatever cost associated with the sale is there, that cost of disposal needs to be taken. Valuation fee, sir, whether valuation fee is a cost of disposal, answer is no. So valuation fee is something where you are getting aware that what is the fair value of my asset, right? And the sale decision will come after that. Examples of cost of disposal: legal cost, stamp duty, other similar transaction taxes. Cost of removing the asset, when you will remove the asset, when you have taken a decision to sell. Special packaging cost, directly incremental cost to bring an asset into condition for its sale, right? Yeah. Then we have done a case study on this fair valueless cost of disposal. Then we have discussed the concept of value in use, and in the concept of value in use, we have discussed that value in use is nothing, it's a present value of future cash flows, right? Expected to be derived from an asset or a group of asset, which is a cash generating unit. So present value of the future cash flow, as simple as that. For calculating present value, discount rate is required. For estimating cash flow, future cash flow is required. Okay. For example, if the life of the machinery is 10 years, you are required to predict what is the cash flow which will be arrived from the machinery in 10 years. And then you have to apply the discount rate, and it will give you the present value of the machinery over a period of 10 years. Right. And while discussing value in use, we have discussed that this value in use, what element should be reflected in value in use? So first of all, estimate of the future cash flow the entity expects to derive from the asset. So while estimating future cash flow, you have to take the cash flow only from the particular asset which is subject to impairment, right? Expectation about possible variation in the amount or timing of those future cash flows. So you need to also factor the possible variation in the amount or timing of those future cash flow, because you have estimated that I'll receive 10,000 every year. So probably you have to do a proper calculation, and you have to consider your possible variation as well. For example, you can predict that, out of 1 year, probably on 6 months or 5 months, the demand will not be there, and hence the cash flow will be, and hence there could be a variation in the amount or timing of those cash flows, right? So you have to factor that. Time value of money, you have to factor the time value of money as well, right? That is discount rate or interest rate. You have to factor other market factors as well, right? And what is the basis for estimate? So standard says the cash flow should be reasonable, and supportable assumption will be there for evaluating the best estimate of the asset. So first of all, there must be a reasonable and supportable assumption of management best estimate of the economic condition over the useful life of the asset, right? So the assumption should be reasonable and supportable. Greater weight should be given to the external evidence. Okay. So you need to provide more weight to the external evidence in comparison to internal evidence, right? For example, useful life. So when you compute, or when you purchase the asset, sometimes vendor gives you a useful life. So you have to rely on the valuers or the vendor's useful life instead of estimating your internal useful life, right? You have to take most recent financial budget or forecast that have been approved by the management. For estimating the cash flow, you have to take the most recent financial budget and forecast, and the cash flow estimate or projection should cover a maximum period of 5 years, until and unless a longer period can be justified, right? So in the question, if the cash flow for 10 years is given, and standard says that the management is indifferent or invariable about the projections of the cash flow, and it could be 5 years or 10 years, and this 10 years period might be not be justified, right? If this kind of information has been given in the question, then you have to take a cash flow for 5 years only for computation of value in use. But I'll take a classic example of airline. If I talk about airline industry, this aircraft has a life of 20 years or 25 years, right? If you will take a cash flow of 5 years, the cash flow should be negative. When I say negative, your outflow is more than the inflow, right? So the airline company will not reach even at a break even in the initial 5 years, right? So of course there is an impairment, but the life is 20 or 25 years, and the objective is not to run this aircraft only for 5 years, right? So in that case, the cash flow projection should not be for 5 years; it should be for 20 years or 25 years. Okay. And what is included in the cash flow? So cash flow should be estimated for asset in their current condition. What I have told you. For example, today you are estimating the cash flow from this asset, right? Cash flow from this factory. And this factory is 10 years old factory and the remaining life is 20 years. So you are not required to estimate the cash flow as per the new factory. You have to estimate the cash flow as per this factory in the current condition, right? Understood? The classic example could be of car. The new car will provide a mileage of, let's say, 20 kilometer per liter. Your car is 4-year-old car and this car is providing a mileage of 15 kilometer per liter. So you are not required to estimate the cash flow as per the new car. You have to estimate the cash flow as per your car, which is an old car. Okay. The second one is cash inflow. You need to take cash inflow and cash outflow from the continuing use of the asset, right? And you have to take a terminal cash flow as well at the end of the life of the asset, right? What is not required to be included? Future restructuring to which an entity is not yet committed. So in this time, you must have heard about that an IPO is coming, right? Or this entity is planning to raise funds from foreign equity investors or private equity investor, PE funds, right? And this company is saying that when we will able to raise fund, so we will invest this into the infrastructure and we will able to increase the capacity, increase the productivity, and we will have more economic benefits in future, right? So if the company is talking about future restructuring for which it is not committed as of date, right? So the increase in capacity or increase in cash flow in future due to this future restructuring will not be taken into consideration in today's calculation, right? Improving or enhancing the asset performance. So you are not required to take cash flow estimating that yes, after 5 years I'll do a major expenditure and after that my asset performance will improve or enhance. You are not required to take those cash flows, right? You are not required to take the cash flows from income taxes and finance cost. Okay. For discount rate, I have told you that the discount rate should be a pre-tax rate. Okay. For example, if the interest rate is 10%, tax rate is 30%. So this discount rate should be 10%, not 7%, right? And what is the discount rate, friends? So the discount rate is, first of all, weighted average cost of capital, which is generally available. And you guys are CA final student in the financial management. You must have learned the concept of weighted average cost of capital. If the weighted average cost of capital is not there, then you have to go for the entity's incremental borrowing rate. If today entity will go into the market and ask for funds and will wants to have a borrowing, then at what interest rate the bankers will provide to this company, right? And other market borrowing rates. Then friends, we have talked about the foreign currency future cash flows, and I've told you that if your asset is generating cash flow in future, for example, you are an Indian company, you have a building in foreign USA, for example. So that building is generating cash flow in foreign currency, right? So in that case, the first step is you have to estimate the future cash flow in the foreign currency, right? The second step, you have to calculate the first, you have estimated the future cash flow in foreign currency. You have to estimate the discount rate which is applicable to that geography or that currency, right? Then you have to calculate value in use. What is value in use? Present value of future cash flows, right? Using the foreign currency discount rate. Okay. Once you get a present value of future cash flow, which is as on date, you have to apply spot rate for converting into Indian rupees or into the local currency, right? So we did this particular case study. Okay. And after that, we did a comprehensive case study where we have calculated value in use. We have calculated the revised carrying value. We have calculated the recoverable amount, impairment loss, revised depreciation. So we did this case study as well. And after that, there is an impairment loss measurement we have discussed. Now we have to start with impairment loss key points. So before that, I would request students, if you have any question, then please let me know. Jay is asking, sir, if indication exists, whether testing to be done at that point of time when indication or year end. J, if the indication of impairment is there, for example, let's say in the month of December, right? You are into quarter 3 and there was some indicator of impairment. The company has incurred a huge losses, or let's say the government has come up with a negative announcement. In that case, you can perform this impairment testing exercise at that point of time, or you can perform this impairment testing exercise at the year end as well. For a listed company perspective, if you are a listed company, in that case you have to publish your results on a quarterly basis, right? So if you have to publish the results on a quarterly basis and there is an indicator of impairment in the month of December, in that case you have to perform in the month of December only, right? And at the end of quarter 3, so that the user of the financial statement will have a true picture. Jay is again asking why discount rate is a pre-tax and why it is not a post-tax. So Jay, first of all, where impairment loss will go, whether impairment loss will go after tax or impairment loss will go before tax. Jay, tell me, in the profit and loss account, if there is an impairment loss, so whether this impairment loss is pre-tax or post-tax, it comes after PAT or it comes before PAT. Of course, all your expenses comes before PBT, profit before tax, right? Right. And hence, this impairment loss is also required to be calculated before tax, right? Coming to the key points on impairment losses. Impairment loss should be recognized immediately in profit or loss unless the asset is carried at revalued amount. So guys, in Ind AS 16 and Ind AS 38, I have told you that if the company has opted for revaluation model, and if there is an increase in the value of the asset, it will go to other comprehensive income, right? So revaluation surplus will go to other comprehensive income. For example, in the first year, there was a revaluation surplus. In the first year, there is an increase and there was a revaluation surplus. So this revaluation surplus goes into the OCI for 100 rupees, right? And in the next year, there is an impairment. There is an impairment of 80 rupees. So where this 80 rupees will go? This 80 rupee will be adjusted from OCI and the balance in OCI will be 20 rupees, right? So this 80 rupee impairment will not go to P&L. It will be adjusted from other comprehensive income. But if the company has not opted for revaluation model, the company has opted for cost model. What is the formula of carrying value in the cost model? Original cost minus accumulated depreciation minus accumulated impairment losses, right? So if the company has opted for the cost model and there is an impairment, that impairment will go immediately to the P&L account. Impairment loss of a revalued asset should be treated as a decrease in revaluation. For example, this 80 rupees impairment loss, it is not an impairment loss. It is a revaluation decrease. It is a revaluation decrease and it has to be adjusted with the other comprehensive income, which you have recognized in the last year, right? Clear? Then you remember we have done one case study in the last class. We have calculated a revised carrying value. So revised carrying value is after impairment and divided by the remaining life will give you the revised depreciation. So adjust the future depreciation based on the revised carrying amount less residual value, right? So after impairment, of course, your carrying value will go down and prospectively you have to charge depreciation on the basis of revised carrying value. Deferred tax assets or deferred tax liability are determined in accordance of Ind AS 12 by comparing the revised carrying amount of the asset with its tax base. Okay. So friends, I hope you have covered Ind AS 12 income taxes. I hope so. You have covered in Ind AS 12 income taxes. So in case of an impairment, standard says that you have to create a deferred tax asset or deferred tax liability, right? You have to create a deferred tax asset or deferred tax liability. So friends, under Ind AS 12 income taxes, how this DT or DTL is calculated? So this DT and DTL is calculated, which is a difference between book base and tax base. When I say book base, it means the carrying value in the books of accounts. And when I say tax base means if the balance sheet has to be prepared according to the income tax provisions, then what is the carrying value as per income tax provision of that asset and liability? That is known as a tax base, right? So my objective is not to teach you Ind AS 12 because there must be a separate session on Ind AS 12, but my objective is how to take care of DTA and DTL as per Ind AS 12 in impairment of assets, right? So friends, book base and tax base. So book base and tax base, what is meant by book base? It is a carrying value as per the books of account. What is meant by tax base? It is a carrying value as per tax books. For example, in companies, for example, there is a cost of asset. The company has acquired an asset for 100 rupees. Tell me what is the book base of the asset? 100 rupees at this point of time. And what is the tax base of the asset? What is the tax base of the asset? The tax base of the asset is of course 100 rupees. Income tax will also recognize that 100 rupees, now whatever value you have paid for acquisition of an asset, income tax will say yes, the value is 100 rupees. The company accounts will say yes, the value is 100 rupees, right? But as per schedule 2 of the Companies Act, the life of the asset, for example, the life of asset is 5 years, right? But as per income tax provision, it is going by the WDV, and the depreciation rate is 10%, or let's say 15% in the machinery. Okay, 10%. So the depreciation which will be charged at the end of the first year will be 20 under book base, under companies accounts, and under tax base, I mean to say under tax provision, the depreciation will be charged at 10 rupees. So under tax provision, the carrying value will come out at 90. Under the book base, under the company's accounts, the carrying value will come out at 80. So when this asset was purchased, the carrying value as per books of accounts, I mean to say book base, and the tax base was same. After 1 year, when it was depreciated, the depreciation was at different rates. So the carrying value as per books of accounts become 80, and the tax base as per books of accounts becomes 90. So there is a difference in the book base and tax base. So friends, tell me in this case whether there will be a deferred tax asset or deferred tax liability. Whether there will be a deferred tax asset or deferred tax liability. Jay, Srinidhi, Sairam, tell me, is it a deferred tax asset or deferred tax liability? Is it a deferred tax asset or deferred tax liability? Few participants are saying DTL, few are saying DTA. Guys, DTA or DTL? In this transaction, whether deferred tax asset will be there or DTL will be there. Guys, in case of deferred tax asset and deferred tax liability, I can tell you, not only students, the professionals, the tenured professionals also get confused whether it is a DTA or DTL. I'll give you a hand trick for DTA or DTL. I will give you a hand trick. And what is this hand trick on DTA or DTL? Let me tell you. So do you want to understand the magic of DTA or DTL? Do you want to understand the magic of DTA or DTL? And with this magic, you will be able to solve all the problems relating to DTA or DTL, whether it will be DTA or it will be DTL. Yeah. Sairam is saying DTL. Jay is saying DTA. Do you want this magic trick? Okay. So students are excited about the magic trick. Yeah, let me tell you, Sai Ram and Jay. And after that, we will decide whether it should be DTA or it should be DTL, right? So you have two hands, right? Take carrying value, which is a book base, carrying value on the left hand. Take income tax value, I mean to say tax base on the right hand. You have two hands, left hand your books of accounts, right hand your income tax books. Are you maintaining income tax books or are you maintaining your books of accounts? You are maintaining your books of accounts as per Companies Act, right? So income tax books has to be prepared as per income tax provisions. So friends, in your left hand, where it is a company's books, where it is a books of accounts, where it is a book base, what is the value? Value is 80. What is the value under carrying value? What is the value? 80 rupees. 80 is the value. Under tax base, the value is 90. So under the tax base, under income tax provision in the right hand, the value is higher. It is 90, right? So friends, you can see there is a mismatch. There is a mismatch between the company's books and the tax base. There is a mismatch, right? And what is the objective of this income tax Ind AS 12 income tax related standard? The objective is to match. The objective is to match the company's provision with the tax provision, right? So friends, in my book base, in my books of accounts, my value of the asset is lower, but under textbooks the value of asset is higher. To match, what I need to do? I need to increase my asset. And where I can do the adjustment? I can do the adjustment only in my books. When I say only in my books, I mean to say company's books, right? So friends, in the company's books, the asset is lower. So I need to increase the asset. I need to increase the asset. So if I need to increase the asset, what should I do? I have to debit the asset. But which asset? Is it a machinery? Answer is no. I have to match the tax implication between the book base and tax base, right? So I have to create an asset. Which asset? Deferred tax asset. I have to create a deferred tax asset. Accounting entry will be deferred tax asset account debit to deferred tax expense, which is goes into the P&L. I hope you guys have understood this magic trick. Jay, Sairam, whether it will be DTA or DTL. Yeah. Jay, Sairam, Srinidhi, Ayush, Paritosh, are you clear on this? Paritosh is saying, sir, wonderful trick. Thank you so much. My pleasure, Paritosh. Guys, have you understood this magic trick of two hands? Since my carrying value was lower, so I have to increase the asset. And when I have to increase the asset, I have to debit the asset. I have to debit the deferred tax asset, right? Right? Clear? Great. So now let's do this case study that in case of impairment, whether it will be deferred tax asset or deferred tax liability, what is the impact of deferred tax asset, right? What is the impact of deferred tax? Yeah. Clear? So Srinidhi, Jay, Sairam, other students as well, you can apply this trick in any scenario wherever you're auditing. For example, your boss will say that provision for gratuity is 100 rupees, it is a liability, okay, and under the tax base it is 0. So whether DT or DTL, so just you have to apply this hand trick. Okay, this is a liability, this is my books of account, it is 100, and this is my tax books, it is 0. It means I have to reduce the liability. So if I have to reduce the liability, what does it mean? I have to reverse the liability. What does it mean? It means I have to create an asset, right? Reversal of liability means creation of asset. Reversal of asset means creation of liability, right? So just you need to put one in one hand books of accounts, in one hand your tax base, and just you have to do this: increase, decrease, increase, decrease. Okay, this will freeze. Your just books of accounts will increase or decrease, right? Okay. Mercury Limited has an identifiable asset with a carrying amount of 1,000 rupees. Its recoverable amount is 650. So guys, Mercury Limited has an identifiable asset with a carrying amount of 1,000 rupees. What is the carrying amount? 1,000 rupees. When I say carrying amount means books of accounts, book base. Its recoverable amount is 650. Recoverable amount is 650. So it means there is an impairment loss. The carrying value is 1,000 rupees. Recoverable value is 650. It means there is an impairment loss. Okay. The tax rate is 30% and the tax base of the asset is 800. So guys, book base is 1,000. Tax base is 100. Tell me DTA or DTL? Book base is 1,000. Tax base is 800. DTA or DTL? I have to reduce my asset. My asset under textbooks is lower than the my asset under book base. So I have to decrease my asset. So it means I have to create a DTL. Right? Right? Is it clear? In this case, the text base is 100, book base is 1,000. So I have to reduce my asset. Which asset? DTA. So reduction of DTA means creation of DTL. Am I right? Am I right? Yeah. So on 1,800, so we can just see here, carrying value, which is book base, is 1,000. Tax base is 800. So there is a taxable temporary difference of 200, and there is a DTL. There is a DTL of 60. 200 multiplied by 30%. This 30% is the tax rate, right? And in the question, it is given that there is an impairment of, there is a recoverable amount of 650. So there is an impairment loss of 350. So when there is an impairment loss of 350, so your carrying value becomes 650, right? After impairment loss, your carrying value will be revised. It will become 650. But in the question, it is given that impairment losses are not deductible for tax purpose. So tax department will say that I don't know what is impairment. Whenever you will have an actual loss, then come to me. Then I will allow. But this is a notional thing. Probably in the next year, you can reverse your impairment. So I don't know about impairment. So income tax department says that in my books, in the tax space, it is still 800. I don't know about any impairment. Okay. But under carrying value, you have to apply Ind AS 36 and you have to reduce the carrying value. You have to recognize the impairment loss. So the book base becomes 650. Now the book base becomes 650. The tax base is 800. So what to do? Asset or liability? Asset or liability? The book base is 650. Tax base is 800. I have to increase the asset. DTA or DTL? DTA. DTA. Right? Right? So it has to be DTA. What would be the impact of impairment loss on related deferred tax asset or liability against the revised carrying amount of the asset? So now after impairment, my book base is 650, my tax base is 800. So I have to create a deferred tax asset to the extent of on 150. So difference is 150 and tax rate is 30%. So I have to create a deferred tax asset of 45 rupees. So if I have to create a deferred tax asset of 45 rupees, but I have a liability of 60 rupees, it means I have to reverse 105 so that I will arrive at 45, right? Is it clear? Is it clear, friends? Yes or no? Let me know if there is any confusion. Yeah. Is it clear? Good. Great. I'm glad that you guys are happy with this magic trick. And I believe that this magic trick you will be able to remember in your lifetime. Guys, are you clear on this? Shall I move forward? Jay, shall I move forward? Okay. So now we have completed the concept of individual asset. Now we are moving towards group of assets, right? So before that, just I need to understand if you have any query, we will discuss that. Otherwise, we will move on to the next concept. Okay, so let's come to the cash generating unit. What is cash generating unit? Guys, what do you understand by cash generating unit? Paritosh is saying cash generating unit is a group of asset. So two participants are saying, sir, can you repeat the DTL point? Please repeat last point. Okay. So let me go back to the DTL point. So guys, initially the carrying value was 1000 rupees and the tax base was 800 rupees. So there is a deferred tax liability, right? My carrying value was 1000 rupees, tax base is 800 rupees. So it was DTL. I need to reduce my asset. It was DTL. And the carrying value was 1000, tax base was 800. What is the difference? Difference is 200. So you have to apply tax rate on this difference, and then you will have a deferred tax asset or liability. So in the first case, it was deferred tax liability. Okay, what was the accounting entry? Accounting entry was deferred tax expense account debit to deferred tax liability. But after that, there is a impairment loss, and under income tax does not consider the impairment loss. So after impairment loss, the carrying value goes down to 650, but the tax base remains consistent. It remains constant. So now if I compare my book base with tax base, my tax base is higher than my book base, so I have to create a deferred tax asset, right? So what is the difference? The difference is 150. 650 is my book base, 800 is my tax base. What is the difference? 150. And difference multiplied by tax rate, 150 multiplied by 30%, 45 rupees is your deferred tax asset. So in the first case, before impairment loss, you have a deferred tax liability of rupees 60, right? Now you have a deferred tax asset of rupees 45. So what to do? What to do? Initially you have a liability, now you have an asset. So you have to reverse 105, it will go to the P&L, right? The first entry, when you have created a deferred tax liability, the first entry you have made is deferred tax expense account debit to deferred tax liability account 60. But now it has to be 45 rupees of asset. So how it will be, how this liability of 60 will get converted into 45 of asset? So in that case, what I need to do? I need to reverse this deferred tax liability. I need to reverse this deferred tax liability. I need to reverse DTL account debit 60. Okay, to DTL account debit 60. Deferred tax asset to be created account debit 45 to deferred tax expense, which is income 105. Okay, so according to this entry, your deferred tax asset will be recognized. DTL account debit 60, because you have to reverse DTL. Now you have to create a deferred tax asset. Deferred tax asset account 45 debit to deferred tax expense 105. Right? This will go to P&L. Is it clear, Sairam and Jay? Is it clear now with this accounting entry? Yeah, I appreciate your quick response. Let's come to the cash generating unit. So cash generating unit is nothing, it's a group of assets. Okay. And Paritosh is saying cash generating unit is a group of asset. It is a smallest group of asset which can generate cash flow. You're right, Paritosh. So what is a cash generating unit? It's a smallest group of identifiable asset which can generate cash flow. In an organization, you must have seen that there is an assembly line. There is an assembly line where multiple machineries are attached. Okay. And the raw material has been put into a particular machinery. It has to take inside into a particular machinery, and this raw material has been processed into the different piece of machinery, and the final output is produced by a particular machinery. So there is an assembly line, there is a chain of machineries which take the raw material and which produces the final output, right? So if I ask you what is the smallest identifiable group of asset which can generate cash flow independently? Is it a single machinery, or is it a group of machine? Is it an assembly line which can generate cash flow independently? When I'm saying which can generate in cash flow independently, when I'm saying this, what does that mean? I mean to say, when you are producing these assets into the market, of course you will generate cash flow, right? So guys, first of all, as far as the concept is concerned, you have to determine the recoverable amount for the individual asset. But if it is not possible to determine the recoverable amount for individual asset, why? Probably that individual asset is not generating any cash flow. How will you calculate the value in use? How will you calculate the value in use? Okay. In that case, standard says that, okay, if that individual asset is not able to generate future cash flow and there is no value in use, then you have to attach this asset with the group of assets. You have to attach this asset to that group to which this asset belongs, to that group to which, that when this asset will be attached, it will provide a future economic benefit, it will be provide a future cash flow, right? So first determine the recoverable amount for the individual asset. If it is not possible to estimate the recoverable amount of individual asset, an entity should determine the recoverable amount of the CGU to which the asset belongs, right? So first the entity has to determine for individual asset. If for individual asset it is not possible, then entity will see that this individual asset belongs to which group, then this individual asset will go to that group, and that group will become CGU. That group is a CGU, and the impairment testing exercise has to be performed for that entire group, right? What is a cash generating unit? It is the smallest identifiable group of assets which can generate cash inflow, which is largely independent of cash inflows from other assets or group of assets. So cash generating unit, first of all, let me talk about a situation here. There is a machinery A. There is a machine A. Okay. So there is a raw material which goes inside the machine A, and the machine processes this raw material and it goes to machine B. It goes to machine B. Then this machine B again produces the material and it goes to machine C. Okay. Finally, this machine C produces output which is sellable in the market. So first of all, let me ask you a question. Whether machine A is able to generate cash flow independently. So a raw material is putting inside the machinery A. Machinery A is processing or crushing that raw material, and then machinery A throws this output to machine B, and machine B, after processing, throws the output to machine C, and machine C finally produces the final output, and this output is sellable in the market. So my question is, can this machine A is able to generate the cash flow independently? Answer is no. Can machine B able to generate the able to generate the cash flow independently? Answer is no. Can machine C will be able to generate the cash flow independently? Answer is no. So having said that, when these three machineries put together, perform some processes, only then the cash flow can be generated. When this final output will be produced, then only cash flow can be generated, right? So in this particular case, can I do the impairment testing of individual asset like machine A, machine B, and machine C? Answer is no. Why? Because if the asset is not generating the cash flow independently, in that case, the value in use of the asset will not be able to calculate it. We will not be able to compute the value in use, right? We will not be able to compute the value in use. Okay. Now I will again define what is the definition of CGU. Definition of CGU is smallest identifiable group of assets which can generate cash flow independently. Now tell me this machine A, B, and C group. Now tell me this machine A, B, and C group, whether this machine A plus B plus C, this group, whether this group will be able to generate the outflow independently, cash flow independently, A plus B plus C. Can I call this A plus B plus C as a CGU? Can I call this A plus B plus C as a CGU? Yes, yes or no? Can I call this A, B, C as a CGU? Yes, this A, B, and C, this group, this three machineries put together is the smallest group which can generate cash flow independently. This is the smallest group which can generate cash flow independently, right? So this A plus B plus C is considered as a cash generating unit. And in this case, since the identification of value in use for a single machinery is not possible because it is not generating the cash flow independently every machine, but these three machines put together is generating the cash flow independently, and hence we are required to compute value in use for this entire A plus B plus C put together, right? Okay, then if there is an impairment loss, we have to allocate this impairment loss in the multiple assets of cash generating unit. How we will do that, I will discuss that, right? But as far as the concept of CGU is concerned, I hope you guys are able to understand the concept of CGU, right? Right, friends? Okay, so I'll take another example. Let me take another example here. Just a minute. Yeah. Friends, there is a bus company. There is a bus company, right? And the bus company has 5 buses. They have 5 routes. This is your bus number 1. This is your bus number 2. This is your bus number 3, 4, and 5. There is a bus company, and bus company has 5 routes, 5 buses. Okay. The traffic corporation, or let's say the government, has given a permit to this bus company to operate into 5 different routes, right? So this company got a permit, got a license to operate in 5 routes, right? To operate in 5 routes. Clear? Operate in 5 routes. Now, if I talk about this first route, let's say it is R1, it is into profit. If I talk about this second route, R2, this is again under profit. This is R3, this is again in profit. This is route number 4, this is into losses. This route number 5, it is again into losses. So guys, now let me give you the more information here. This is a bus company, and the government has given a license or a permit to this bus company to operate into 5 different routes, right? And government has given the permit for 5 different routes, and this bus company has to operate into these 5 routes put together. This bus company does not have any choice that this company will operate into route number 1, 2, 3 and will not operate into route number 4 and 5. This company will not have any choice. The government has given these 5 routes as a part of the license or as a part of the permit, right? So if this company will deny that I will not operate in route number 4 and 5, the government will not allow this bus company to operate in route number 1, 2, 3 as well. Now my question is whether these 5 different routes has to be seen as a different cash generating unit or different assets. For example, for every route, buses are different. For every route, ticket collection is different. For every route, there is a different driver, different conductor. So cash flow, entire cash flow of different routes are separate. The assets and liabilities of different routes are separate. So my question to you guys is whether these 5 routes can be considered as a separate assets for the purpose of impairment calculation. For example, you will say that sir, only route number 4 and 5 is into losses. So what you can do, you can simply say that you have to do the impairment testing on route number 4 and 5 and not on the route number 1, 2 and 3. So my question to you is whether this bus company has to take into the consideration as a 5 different asset or take into the consideration these 5 routes put together as a cash generating unit. What is your view? Whether these 5 routes put together is a CGU or it is a different asset, 5 different assets. Guys, this 5 routes put together, number 1, 2 and number 4, the entire contract is not a single contract, right? So the entire cash flow has to be seen from the overall perspective. R1 plus R2 plus R3 plus R4 plus is seen from the total. Company is not allowed to operate. It has to be taken collectively. So this unit, right? So we will do illustration number 16, which is the same illustration which I already discussed. A bus company provides services under contract with the municipality of 7 separate routes. On each of 7 separate routes, assets on every routes, the buses are different. So of course the cash flow from each route can be identified separately. Or for a cash generating unit. So of course it is for a cash generating unit. Because the entity does not have the option to curtail any one bus route, the lowest level is the cash inflow level, the smallest lowest level of identifiable cash assets or group of assets is the 7 routes, 7 buses as a whole, right? Clear? So guys, are you able to hear me? Guys, are you able to hear me? ICI technical team, are you able to hear me? Whether my whether my video is stuck? अभी भी हो रहा? Okay. So just give. So we can do one thing. So we can just have a break now. Okay. I have to check my bandwidth as well. So just have a 10 minutes break. Okay. Yes. 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 Yes, 10 minutes break. Yeah. Yeah. Yeah, friends, in the bus company example, so we have seen here that if the company has a 5 routes, okay, and the municipality has given a permit to operate on each of these 5 routes, okay, so they don't have any option that they can cut down a single route. They can cut down a single route. So in this case, as far as impairment testing is concerned, so these 5 routes are not required to be seen as an individual asset. These 5 routes has to be taken collectively as a cash generating unit. Although each route is generating a cash flow independently, right? Each route has a separate assets. The separate asset has a value, but still, since the license or permit has been given to operate on these 5 routes put together, and hence it is a cash generating unit. Collectively, these 5 routes are cash generating unit, right? I hope you guys have understood this example. Srinidhi, Mahendra, Jay, Sairam. Yeah. Now, what are the factors to be considered in identification of CGU? First, the cash generating units, it should be able to generate independent cash inflow from other assets. So ability to generate cash flow should be there. For example, there is 3 machinery A, B, C. Again, I am taking an example. So machine A, B, and C is there, right? This machine is producing a output, these 3 machines, and these 3 machines are transferring this output to D, right? And D is finally producing an output, okay, and selling it into the market. If A, B, and C, the output produced by A, B, and C is not utilized by D, then this output is also sellable in market. Okay. Although this output, this company is not selling this output, this company is using this output for internal consumption. But if company wants to cut down this D's operations, if the company wants to remove this D's operation, then the output produced by A plus B plus C is also sellable in the market. So standard says that in this particular case, although the output produced by A plus B plus C is not sellable in the market, but it can be sold out in the market. And hence we can say that this A plus B plus C is able to generate cash flow independently. So for identification of CGU, you are not required to only look from this perspective that, okay, so the output produced by this set of machineries are not getting sold in the market and hence it is not a CGU. The situation is not that. You have to see whether this output can be sellable in the market. If answer is yes, then you need to recognize that group of asset as a cash generating unit, right? So the first factor which needs to be considered in identification of CGU is ability to generate independent cash inflow from other assets. The ability to generate cash flow should be there. If an active market exists for the output produced by a group of assets, that group of assets should be identified as a cash generating unit, even if some or all of the output is used internally, right? Second, for identification of cash generating unit, it is very important how management is making a decision about continuing or disposing of assets or operation. For example, at times management is monitoring operation on a geography basis, right? India operation, China operations, okay, Bangladesh operations. Sometimes management is taking a decision or monitoring operations on a product line basis. For example, FMCG sector, for example, automobile sector, cement sector, right? Or in the automobile, like vehicle, what I can say that passenger vehicles, private vehicles, right? So management is monitoring operations on a product line basis. Sometimes management is monitoring the product monitoring the operations on a location basis. For example, management has a 5 factory. So Bhilwara factory, Delhi factory, Punjab factory, right? So they are taking a decision on or monitoring operations on a location basis. So two things are very important for identification of CGU. One, ability to generate independent cash inflow. Second, how management is making a decision about monitoring operation. That is again very important. So guys, once cash generating unit has been identified, it has to be consistent from one period to another until and unless a change is justified, right? So friends, in the examination question, be it a GFRS paper or be it a financial reporting paper, so if it is given that there are two machineries are producing an output which is using internally by the another set of machineries, right? If the output which is not consumed by those set of machineries, that output will be sold out in the market or is sellable in the market. So in that case, you need to understand that even though the output produced by a particular set of machinery is completely used internally, but still it is sellable in the market, it means this particular set of machinery is again a cash generating unit, because it is able to generate cash flow independently, right? It is able to generate cash flow independently, right? Is it clear? Yeah. So again, coming to an example, a mining entity owns a private railway to support its mining activity. You must have seen some mining, mining sites. For example, Adani has some mining sites or some coal sites. So at a mining site, there is a railway track, right? And that railway track is used for a private railway and to just loading and deloading to carry the mining ores, right? And even though in the mining there is a track, so this vehicle goes, this private railway goes, and the mining ores are loaded on this private railway, and then it comes out. Okay, so this private railway is does not having any uses apart from this mining activity, right? So a mining entity owns a private railway to support its mining activities. The private railway could be sold only for a scrap value. There is no passenger, there is nothing else. The objective of this mining entity is only to carry out the mining ores, and it can be sold only for the scrap value. It does not generate cash inflow that are largely independent of the cash inflows from other assets of the mine, right? Should the entity determine the recoverable amount of the private railway or the mining business as a whole? So guys, if you see the mines, there are cranes, there are tracks, there are private railway, right? But these assets are not generating cash flow independently until and unless these assets are put together collectively, right? So this private railway again is not an independent asset which can generate cash flow. The entire mining activity, the entire group of assets put together will be able to generate cash flow independently, right? So this private railway is not, the recoverable amount of private railway cannot be determined, the value in use cannot be determined, and hence this mining business as a whole can be considered as a CGU. It is not possible to determine the recoverable amount of the private railway because its value in use cannot be determined and it is probably different from scrap value. Therefore, the entity estimates the recoverable amount of the CGU to which the private railway belongs, which is a mining business as a whole, right? Is it clear, guys? I hope it is clear to everyone. Now coming to the goodwill. So friends, we have understood the group of asset concept, cash generating concept. What is the cash generating concept? It's the smallest group of identifiable asset which can generate, the word is not generate, which can generate cash flow independently, right? Now coming to the goodwill for allocation to cash generating unit. So guys, my first question, whether internally generated goodwill can be allocated, whether internally generated goodwill can be allocated to multiple cash generating unit. Please listen my word very carefully. Whether internally generated goodwill, yeah, nice. Ayush is saying, sir, internally generated goodwill is not allowed to be capitalized, not allowed to be recognized as per Ind AS 38. Absolutely perfect, Ayush. Internally generated goodwill is not allowed to be recognized as per Ind AS 38. So there is no question of internally generated goodwill. Sir, then we are talking about which goodwill? We are talking about goodwill which is arising in business combination, the goodwill which is acquired in a business combination. So A Limited is acquiring B Limited at a purchase consideration of 100 rupees. The value of the net assets of B Limited is 80 rupees. So what is this 20 rupees? why A Limited is paying additional 20 rupees for acquiring the net assets of B Limited? Because A Limited is forcing some future economic benefits, because A Limited is forcing some synergies in the operations, right? And that is why A Limited is paying a premium of 20 rupees extra, right? And what is that premium? That premium is a goodwill. But goodwill is kind of a fictitious assets, right? So goodwill alone cannot do wonders, right? For example, I am saying that Alok Garg name is a brand. Okay, Alok Garg is a goodwill, name of the Alok Garg. But whether my goodwill can perform everything, answer is no. Until and unless I will not put my efforts, I will not put my assets, my goodwill will not grow, right? Can I say that, okay, I'll not take any lecture going forward, so whatever it will be taken by my goodwill? And we have seen that goodwill is not a separable asset, right? Goodwill cannot be separated from a business as a whole, right? It will travel together with the business. So friends, one thing is very clear, that goodwill which is acquired in a business combination has to be allocated to the multiple cash generating unit, right? Now the question arises, this goodwill has to be allocated to which cash generating unit? So goodwill has to be allocated to those acquirers cash generating unit which is expected to benefit from the synergies of the combination. For example, A Limited is a pharmaceutical company and A Limited acquire B Limited, which is again a different pharmaceutical company. B Limited has a different formula for which A Limited has paid a premium, right? For acquisition of B Limited, A Limited has paid a premium of, let's say, 20,000 crores, which is a goodwill. But by acquisition of B Limited, A Limited will have a synergies in their 5 factory. For example, A Limited has a 5 factory where A Limited used to produce the medicines, right? And after getting this formula, the productivity, the efficiency, the capacity of these 5 plants will grow, will increase, will enhance, will improve, right? So it means due to the acquisition of B Limited, this A Limited operations will synergize. There will be synergies in the operations of A Limited, right? It means whatever goodwill we have invested in the goodwill, we have paid extra premium of rupees 20,000 crores. This 20,000 crore has to be allocated into these 5 cash generating unit, which is 5 factory or which is a 5 plant. Second example could be, for example, there is an automobile company, let's say MG, right? Morris Garages, MG. Have you heard about MG, Hector? Have you heard about MG? Right? This is a new company which is into the market, automobile market. Now, for example, MG will purchase Maruti Suzuki India Limited. I'm just taking a hypothetical example. And MG will pay a premium for acquisition of Maruti. Why? Maruti has a largest dealership network in India. Maruti has a largest distributorship network in India, right? Largest distributionship network in India, Maruti. So by acquiring Maruti, this Morris Garages, this MG automobile company can reach out at every parts of India, right? Be it a rural part, be it a urban part, just using the dealership network, just using the network of Maruti Suzuki India Limited. So if MG will pay a premium in acquisition of Maruti due to this dealership network, distributorship network, due to the different showrooms, service center, which is located in every parts of India. So that premium is a goodwill. And why MG will pay a premium? Because due to this acquisition, this MG's operations will also synergize. The capacity will also increase, because in the rural parts, many people are not buying MG vehicles. Why? Because either there are no showrooms or there is no service centers, right? But if it will acquire Maruti, then every Maruti service center has a service center of MG as well, right? So the customer will come automatically. So at every Maruti showrooms, probably they will be able to, put their MG vehicle as well, right? So it means there will be a synergies in the MG's operations also. So this goodwill has to be allocated to multiple cash generating unit of acquirer, multiple cash generating unit, which is expected to be synergized from the benefit of this combination. I hope it is clear to everyone now, guys, right? So goodwill acquired in business combination should be allocated from the acquisition date to each of the acquirer CGU that is expected to benefit from the synergies of the operation. And such allocated cash generating unit should represent the lowest level, right, on which the goodwill is monitored. So this goodwill has to be allocated at the lowest level of cash generating unit where the monitoring is possible. And we have seen the definition of CGU. It is smallest identifiable group of assets which can generate cash flow independently, right? And you must have read Ind AS 108. In accounting standard, it was AS 17, operating segments. You must have read that there are segment reporting. There are segments like operating segments, like business segment, geographical segment. And it says that lowest group of CGU, that lowest cash generating unit should not be larger than the operating segment, right? It should not be larger than the operating segment as per Ind AS 108. Is it clear? Yeah. I hope it is clear to each one of you guys. It was a theoretical part. We have discussed the cash generating unit, how to identify a cash generating unit. So cash generating unit, for identification of cash generating unit, you need to see whether this group of asset is capable of generating cash flow. Second, you have to see how management is monitoring the operation. Third, the CGU should be consistent from one period to another. How this goodwill should be allocated? Goodwill should be allocated on a reasonable basis, on a rational basis, right? And goodwill has to be allocated on the acquirer cash generating unit, which is expected to be benefited from the synergies of the operations, right? Second, this goodwill has to be allocated at lowest level. Third, that this lowest level or this cash generating unit should not be greater than the operating segments, right? It should not be greater than the operating segments. Let's move on. Yeah. So any doubts so far, guys? Shall I move forward? Sairam, Pushkar, Srinidhi, Mahendra, Jay. Any doubt? Ayush, Paritosh, any doubt? Okay, let's move on. Now coming to the frequency and timing of impairment testing. So friends, if there is a cash generating unit, and this cash generating unit is having a goodwill, intangible asset with indefinite life, or intangible asset not yet available for use. Remember these three exceptional assets. And what we have discussed that in case of these three exceptional assets, goodwill arising in business combination, intangible asset not yet available for use, and intangible asset having indefinite life, in these three exceptional assets, the impairment testing has to be performed at least once in a year, right? Sir, if we do have indicators, and I have told you that in case of these three assets, you are not required to wait for the impairment indicator. You are not required to see the impairment indicator. If there are no impairment indicator, even though you have to do the impairment testing exercise at least once in a year. Sir, if we do have more impairment, for example, while I was closing the Q1 result, there was an impairment indicator. Do I need to do the impairment testing of these assets on Q1? Answer is yes. Sir, while closing the Q2 results, I do have an impairment indicator in these kind of assets. Do I need to again repeat this impairment exercise? Answer is yes. Sir, in Q3, again, there was an impairment indicator. Yes, still you have to do an impairment exercise. In Q4, yes. But sir, you have told that this impairment exercise on these three exceptional assets has to be performed only once in a year. Only once in a year. Okay, it is mandatory. But if there is more frequent impairment indicator, whenever there is an impairment indicator, you have to perform at that point of time also, right? So if there is a cash generating unit with these three kind of assets, Okay. In that case, if there is an indication of impairment, then test for impairment when there is an indication. If there is no indication of impairment, then test for impairment annually, right? So at least once in a annually to karna hi karna, you have to do once in a year. But if it is more frequent indicator, then you have to do more frequent this impairment exercise, right? Sir, what happens if the cash generating unit is not having these three assets? Then what happens? There is a normal cash generating unit. It does not have any goodwill. It does not have any intangible asset with indefinite useful life, and it does not have any intangible asset not yet available for you. Then what will happen? In that case, if there is an indication of impairment, then you have to test for impairment. If no indication for impairment, then you are not required to perform this impairment exercise. You remember, we have discussed that an asset which needs to be identified for impairment. So we have discussed that the entity has to identify and test for impairment only when there is an indication for impairment. But for three assets, we have discussed that the indication of impairment is not important. You have to perform at least once in a year. But if it is more frequent indication of impairment, you have to do more frequent impairment exercise for those three assets, right? But if the CGU is not having goodwill, not having intangible asset with indefinite useful life or not yet available for use, in that case, you are not required to perform impairment testing if there is no indication of impairment. If there is indication of impairment, then you have to test for impairment, right? I hope it is clear to everyone, friends. I hope it is clear to everyone. Let me know if you have any doubt. Yeah. Clear? Let's move forward. Impairment testing, other key points. Annual impairment test for a CGU to which goodwill has been allocated may be performed at any time during an annual period. I have told you that these three assets, like I have told you, these three assets, intangible asset having indefinite life, goodwill arising in business combination, and intangible asset not yet available for use. These three assets, on these three assets, impairment testing can be performed any time during the year. But the time period should be, the gap or interval should be consistent from one period to another. Okay. So the impairment test should be performed at the same time every year, the frequency. Different CGU may be tested for impairment at different times. For example, there are CGU 1, CGU 2. This CGU1 was performed in Q1. This impairment testing on CGU2 was performed in Q2. So in the next year, it has to be in Q1. In the next year, it has to be in Q1. In the next year, it has to be in Q2, right? So different CGU, the impairment testing on different CGU can be performed at different point of time. But yes, it has to be performed same time every year, right? While calculating the cash generating, while calculating the recoverable amount, or while calculating the recoverable amount of CGU, recent calculation made in a preceding period can be used if the following criteria are met. Sir, do I need to compute recoverable amount of CGU every time? Standard says that whatever calculation you have performed for recoverable amount, whatever calculation you have performed, whatever future cash flow projections you have made, so whatever you have done, you can apply that, you can use that, provided some condition needs to be satisfied. First, the composition of the CGU has not changed substantially. If the composition of the CGU has been changed, then of course you need to estimate the future cash flow of this new CGU. Of course, you have to do that. But if the composition of the CGU has not been changed significantly, and most recent recoverable amount, so recently whatever recoverable amount you have computed, this has exceeded the carrying amount by a substantial margin. So in the last time when you have computed the recoverable amount, so this recoverable amount was higher substantially in comparison to carrying value. For example, 20% higher, 10% higher, right? And there is a remote chances of likelihood that current recoverable amount would be less than the carrying. So three conditions would be satisfied. If the three conditions would be satisfied, then you can okay with taking the same calculation which you have taken in the last year, right? First, the CGU composition should not be changed. Second, last year the recoverable amount was higher significantly in comparison to carrying value. Third, there is a remote chances of likelihood that the current recoverable value is lower than the carrying value, right? On the basis of current facts and circumstances. Okay, guys, any doubt, friends? So these were the theoretical part. Just you need to understand how this goodwill has to be allocated and how this, if there is a CGU where intangible asset having indefinite life, or I would say 3 exceptional assets are there, then every time you need to do the impairment. Hello. Yeah, let's start. Coming to the corporate assets, right? So friends, when you look at your companies, am I audible now? Yeah. So when you are going for articleship, you must have seen that there is a finance department, right? If I talk about finance department, so whether finance department is a profit center or it is a cost center, finance department is always considered as a cost center, right? Sales and marketing is considered as a profit center. Why? Srinidhi, are you able to hear me now? I hope now you guys are able to hear me. Yeah. So friends, if I talk about finance department, it is a cost center, right? Because finance department used to monitor the operation financially. They are preparing the balance sheet, financial statement. They are doing day-to-day accounting, right? They are not directly involved in generation of revenue or generation of future economic benefits. But you all are chartered accountant. Can you assume, can you believe that the company can survive, the company can survive in absence of a finance department? Whether finance department is important for any company? Yes, it is very, very, very important, right? The company cannot survive in absence of the finance department. The CFO is equally important like a CEO, right, of a company. But this finance department is considered as a cost center. Okay. Likewise, if I compare between a factory building and a office building, a factory building and head office building, whether my factory building is a cost center or it is a profit center. Guys, tell me, my factory building is a cost center or a profit center? The factory building is not a cost center. Why? Because the factory building is directly associated with production of goods or services. So when these goods will be produced, these goods will be sold in the market, these goods will getting sold in the market, and then you will able to generate future economic benefit, right? So factory building is something where value in use can be derived, where recoverable value can be derived, value in use can be derived. But if I talk about office building, there is no value in use for office building, because office building is a cost center. Office building is something which is into administration. Office building is something which supports the entire business, right? Which supports the entire business. Okay. So now the question arises, what is the corporate asset? The corporate asset is kind of an office building, right? So corporate asset are those assets which helps in operating the business, which helps in administering the business, which is not directly related to the future economic benefit, which is not directly related to the production and supply of goods and services. But yes, it is important for any business to grow and sustain. Second, if you see the pharmaceutical or IT companies, they do have a R&D center, research and development center. And in these R&D center, a lot of scientists are there, doctors are there, and they are doing a lot of research and development. Again, this R&D center is again kind of a cost center until and unless the development phase has not been started. And the company is spending huge crores and crores on these R&D centers, right? But this R&D center is very important for any company. So these are kind of a corporate assets. So now the question arises, if there are corporate asset, then and this corporate asset are not generating future economic benefit. I mean to say, these corporate assets are not something which generate cash flow independently. In that case, how the impairment testing has to be performed on a corporate asset? Are you getting me? For example, there are 5 factory building. Of course, these 5 factory building are different 5 assets. You can compute the recoverable amount on this 5 factory building. But if there is a one office building, then how will you do the impairment testing on this one office building? It is a corporate asset. Standard says that if there is a corporate asset, this corporate asset has to be allocated into the different CGUs on a reasonable basis for the purpose of impairment testing, right? So let's understand this much better with the help of a case study. Corporate assets are assets other than goodwill that contribute to the future cash flow of both the CGU under review and other CGU. See, like goodwill, you cannot see goodwill, but goodwill is important. Goodwill is something which synergize the operations, which improve the efficiency in the operations, right? Which provide the efficiency in the operation. Likewise, corporate assets are those assets other than goodwill which contribute to the future cash flows. If the finance department, if the head office will not tell you what is your production trend, what is your profitability level, what is your collection level to the sales and marketing team, how can you analyze your performance? How can you improve your performance? So it is very important for the future, for the generation of future cash flow, for supporting the business to generate the future cash flow by delivering the MIS at reasonable or at frequent times, right? Distinctive characteristics of corporate assets are that they do not generate cash flow independently, right? So these head office building does not generate cash flow independently. Hence, the recoverable amount of an individual corporate assets cannot be determined. Why? Value in use cannot be determined because they are not generating cash flow independently. Therefore, recoverable amount is determined for cash generating unit to which the corporate asset belongs and is compared with the carrying amount of the CGU. For example, there are 5 CGU. CGU 1, 2, 3, 4, 5. And there is one corporate asset. So this corporate asset has to be allocated in the ratio of value of these 5 CGUs for the purpose of impairment testing, right? Only for the purpose of impairment testing. So friends, let's discuss the case study on corporate assets, and this is a very important case study. I hope you are able to see the institute study material, which is illustration number 8. Let me know if you are able to see this illustration number 8. Are you able to see this illustration number 8? Can any of you confirm me quickly, please? So there is a illustration number 8 which talks about the corporate asset concept, how to allocate impairment loss on corporate asset, how to compute recoverable amount of a CGU including corporate asset, how to allocate the value of the corporate asset into multiple CGU. So these concept has been taken care under this illustration number 8. Yeah. So I hope this illustration number 8 is visible to everyone. Earth Infra Limited has two cash generating unit A and B. There are two CGU A and B. There is no goodwill within the units carrying values. There is no goodwill. Okay. The carrying value of the CGUs are CGU A for 20 million and CGU B for 30 million. There are two cash generating unit A and B. The carrying value of A is 20 million. Carrying value of B is 30 million. The company has an office building which it is using as an office headquarter and has not been included in the above values and can be allocated to these CGU on the basis of their carrying values. So company has an office building which is a corporate asset, and the carrying value of this corporate asset is 10 million. So this 10 million can be allocated in the ratio of carrying value of CGU A and CGU B, 20:30, right? The recoverable amount are based on value in use of 18 million for CGU A and 38 million for CGU B. The recoverable amount of CGU are also given. Determine whether the carrying value of CGU A and B are impaired. What is the demand of the question? So if I talk about this question, 4 informations are given in this question. 1, there are two cash generating unit A and B. The carrying value of cash generating units are given 20 million, 30 million. The value of the corporate asset is given 10 million. It is also given this 10 has to be allocated in the ratio of 20:30. And the recoverable amount. So carrying value is given, recoverable value is given. If the recoverable value is lower than the carrying value, then of course impairment loss will be there. And the recoverable amount of CGU A and CGU B is given, which is 18 and 38. The demand of the question is determine whether the carrying value of the CGU A and B are impaired and what is the revised carrying value of corporate asset, right? I hope question is clear to everyone. I hope the question is clear to everyone. Yeah. So let's do this question. Let's solve this question. Okay. So let me move on to my Excel file and please confirm if this Excel file is visible. Illustration number 8. Right, illustration number 8. In illustration number 8, what is given in the question? First of all, the corporate asset is given in the question, corporate asset, which is 10 million, right? The value is 10 million. CGU A, the carrying value is also given in the question, carrying value. Sorry. CGU A, CGU B. It is 20 and 30 million. Right, it is 20 and 30 million, right? And the recoverable value is also given in the question. So let me put here these information. Just recoverable value is also given. CGU A, CGU B. 18 million, 38 million. Right? So these informations have been given in this question. These information have been given. So now let's solve this question. Let's understand how this corporate asset has to be allocated in the ratio of CGU, how this impairment loss will be computed, and how this impairment loss will be allocated to the corporate asset, right? So we have to do these three exercises. First of all, this is CGU A, this is CGU B, and this is total, and this is particulars. I hope this Excel file is clearly visible, guys. Or let me know if I have to just increase the size of the screen. Yeah. So carrying value. What is the carrying value? 20 million, 30 million, and the total is 50 million, right? So let's put it here. Total is 50 million. Clear? Now, corporate asset. So corporate asset has to be allocated in the ratio of 2:3. So what is the value of the corporate asset? 10 multiply by 20 divide by 50. 10 multiply by 30 divide by 50. 6. And the total comes out at 10, right? So carrying value of CGU after including corporate asset. This plus this, 24, 36, and 60, right? Clear? Is it clear? Yeah. So this is my carrying value of CGU after allocation of corporate asset. Now the recoverable value is also given. So recoverable value, it is given. For CGU A, it is 18 million. For CGU B, it is 38 million. What is the total recoverable value? Let's see, the total recoverable value is my 56 million. Sorry, is 56 million. Guys, tell me, when impairment loss will be there? Impairment loss will be there when the carrying value is greater than the recoverable value. So in this case, whether impairment losses will be there? Impairment loss. In CGU A, the carrying value is 24 after allocation of corporate asset, but recoverable value is 18. It means there is an impairment loss of 6 million. In CGU B, the carrying value is 36, but recoverable value is 38. It means there is no impairment. No impairment, right? There is no impairment. So in this case, only impairment loss has to be allocated to CGU A. Now, how this CGU A, how this impairment loss of 6 million has to be allocated in the CGU A and the corporate assets? First of all, impairment loss allocation. Impairment loss allocation. CGU A and corporate asset. How to allocate the impairment loss on CGU and corporate asset? In the ratio of their carrying values. In the ratio of their carrying values. 6 million multiply by 20 million divide by 24 million. 6 million multiply by 4 million corporate asset divide by 24 million. 1 million. So it means the impairment loss is going to be allocated between corporate asset, which is office building, and CGU A in the ratio of their carrying value, which is 5:1 million. Now what is the revised carrying value? Now what is the revised carrying value? Revised carrying value. The revised carrying value of CGU A, CGU B, and CGU A, CGU B, and corporate asset. The revised carrying value of CGU-A is 20 minus 5 million. The revised carrying value of CGU-B, it is your 30 million because there is no impairment in CGU-B. The revised carrying value of corporate asset, it was 10 million earlier. So 10 million minus 1 million is the impairment, 9 million. So these are the revised carrying values. So the total of the revised carrying value is 54 million. And what was the existing value? What was the earlier carrying value? What was the earlier carrying value? So earlier carrying value. What was the earlier carrying value? The earlier carrying value was CGU-A 20 million, CGU-B 30 million, corporate asset 10 million. What is the total here? The total here is 60 million. So you can see there is an impairment loss of 6 million, right? Is it clear to everyone, friends? Is it clear to everyone? Or let me know if I need to repeat any concept again. Let me know if it is clear to everyone or I need to repeat any concept. Yeah. Let me know if it is clear to everyone or I need to repeat any concept. Mahendra has confirmed that it is clear, sir. Paritosh has confirmed. Megha has confirmed. So guys, what we have done. So first of all, what was the step one? If I just put it as a step one, allocate corporate asset in the ratio of CGU, right? Step one. What was the step two? What was the step two? Step two was calculate carrying value of CGU after including corporate asset value. Step three. What is the step three? Compare the total carrying value under step two with recoverable amount. Step four. Compare the total carrying value with recoverable amount, then allocate, then calculate impairment loss, if any, then allocate impairment loss in CGU and corporate asset in the ratio of their carrying value, right? This is my step 5. Yeah. So these are the 5 steps of your corporate asset calculation, right? And let me put these 5 steps here on the top of this case study. Clear? I hope it is clear to everyone now, guys. So, Srinidhi, in case there is no impairment on CGUB, so we have did nothing. You can see that the revised carrying value of CGUB was 30 million and the existing carrying value was also 30 million, right? So there was an impairment in CGUA only. So we have just allocated the impairment on CGUA and corporate asset to that extent, right? Okay. So there was no treatment in CGUB. I hope it is clear to everyone now. So guys, now let's discuss the next concept, very important concept, allocation of impairment loss. Allocation of impairment loss in CGU. So far we have discussed the concept of allocation of impairment loss on corporate asset, how to deal with the corporate asset. Now this is very important concept, allocation of impairment loss. In exam, from the examination point of view, it is very important. Allocation of impairment loss on CGU. There is a CGU in which 4 assets are there. There is a CGU in which 4 assets are there: goodwill, building, software, and machinery. So let me put tangible at one place and intangible at the end, right? There was a carrying value CV. There was a carrying value of these assets, assets of the CGU. Goodwill, let's say it is 20 million. Building, it is 30 million. Machinery, it is again 20 million. Software, it is again a 20 million. The total comes out at let's say 90 million. Okay, or the total comes out at 90 million, right? So guys, this is the carrying value. Now, in the question, it is given that the recoverable value of CGU is rupees 30 million. Is rupees 30 million. Compute impairment loss on CGU and show how to allocate the impairment loss on multiple asset of CGU and their revised carrying value post impairment, right? So friends, standard says that first of all, if you have an impairment loss, okay, so my carrying value is 90 million. So the recoverable value is not 30 million, it is 60 million, right? My carrying value is 90 million. My recoverable value is 60 million, right? So what is my impairment loss on the CGU? What is my impairment loss? My impairment loss is 30 million. It is 30 million. Okay. My impairment loss is 30 million. I hope it is clear to everyone. My impairment loss is 30 million. Now, how to allocate this impairment loss, right? Allocation of impairment loss. The total loss is 30. The total loss is 30 million. Everybody knows that. Why? Because 90 minus 60, 30. So 30 million is the impairment loss. Now, how to allocate this 30 million of impairment loss? So standard says that if there is an impairment loss in the cash generating unit, in the group of asset, if there is an impairment loss. So Jay is asking a very good question, sir, whether in the book CGU is recognized or individual asset. Individual asset is recognized, right? So CGU calculation is there, like if you talk about segment. In segment reporting, segment is not recognized in the book. Segment is disclosed in the notes to accounts, right? So segment is a computation or a calculation, but recognition segment is not a recognition, right? So friends, standard says that in case where there is an impairment loss on the group of assets, first of all, you have to hit your goodwill from the loss, right? Why? Because goodwill is a fictitious assets kind of thing. And when you are saying that my 90 rupees value becomes 60 rupees, it means first of all, you have to adjust your goodwill. It means the goodwill is deteriorating, right? You have to adjust your goodwill. So first of all, out of this 30 rupees of impairment loss, what I will do? I will hit the goodwill completely. So after hitting the goodwill, okay, I have what amounts I have been left. I have been left with 10 rupees. I have been left with 10 rupees, right? So in that case, what I'll do, I'll allocate the impairment loss pro rata on the remaining asset on the basis of their carrying value. So minus 10 multiplied by 30 divide by what? Divide by total of 30 plus 20 plus 20. Total of divide by sum of. I'm just putting a sum here so that you will be able to remember this. This minus 4 million, right? Just I'm rounding it off into the nearest rupee. Again, minus 10 multiply by 20 divide by these pro rata of these three assets, the ratio of these three assets, right? Again, minus 10 multiply by 20 divide by sum of these three assets, right? So this is comes out at 30. This is comes out at 30 rupees, right? So this is the 30 rupees. Impairment loss is 30 rupees. Then what is my revised carrying amount? What is my revised carrying value? My revised carrying value, because I need to calculate this revised carrying value, because Jay has a very important question. I need to recognize these assets in my books on an individual basis, not on a corporate basis, not on a group of asset basis, right? So this is my revised carrying value of 60 million. If you will see in this revised carrying value, there is zero goodwill. Okay, there is zero goodwill, and this 30 becomes 26, 20 becomes 17, 17. So guys, in case there is impairment loss on CGU, then what you are required to do? First step, adjust the goodwill to the extent of impairment loss, right? Then adjust the other assets in proportion to their carrying values, right? I hope it is clear to all of you. I hope it is clear to all of you guys. Now I am making this thing little complex, right? So let me come here. Case 2. This was case 1. And now I am putting case 2 here. Same information is given. The recoverable value of CGU is 60 million, right? Compute impairment loss on CGU and show how to allocate the impairment loss multiple as CGU. Revise carrying value post impairment, right? And one more information is given. The value of building, the recoverable value of building, the recoverable value of building is 32 million. This information is also given. So guys, in a cash generating unit, there could be one or two assets where the recoverable value can be determined. Okay, why? Because probably there is one asset. This is, for example, this is a laptop, right? And there is a carrying value of the laptop. There is a recoverable value of the laptop. But this pen is attached to this laptop. This pen does not have any independent cash flow. So that is why this pen has to be attached to this laptop, so that this will become a cash generating unit, and we can identify the impairment loss, if any, on this pen as well, right? So when we are forming a cash generating unit, it does not mean that a individual asset in the cash generating unit does not have a recoverable value. One or two assets could be having a recoverable value. So why these assets are in the cash generating unit? Because the other assets are not having a recoverable value. That is why those assets are attached with these assets, right? Which is having a recoverable value, right? So in this question, in this case too, all the informations are same. The only change is the recoverable value of building is given, which is 32 million, which is more than the carrying value. So friends, in this case, first of all, standard says that whatever impairment loss is there, what is the impairment loss of this CGU? The impairment loss of the CGU is again 30 million, right? So 90 million minus 60, 30 million. So now we have to allocate the impairment loss. First of all, we have to hit the goodwill, 20 million. So revised carrying value of goodwill will become 0. Now we still have 10 million. Do I need to recognize any impairment on 30 million? Answer is 0. I don't have to recognize any impairment on building. Why? Because the recoverable value is more than the carrying value, hence no impairment. And the remaining impairment of 10 million has to be allocated in these two remaining assets pro rata. Divide by sum of. So in the ratio of 20:20, simple. Minus 10 multiply by 20 divide by 40. Minus 10 multiply by 20 divide by 40. Right? So this will be the carrying value of these assets. And this total comes out at 60 million. Right? I hope it is clear to everyone now. So if a particular asset has a recoverable value more than the carrying value, then you are not required to charge any or allocate any impairment loss on that particular asset, right? Yeah, Sairam, you are right. Guys, am I audible? Guys, whether my audio and video is clear to everyone? Please let me know if my audio and video is clear to everyone. Yeah. So, yeah. So guys, Sairam, when goodwill is shown in the balance sheet, if the goodwill is there and whatever goodwill is allocated to the cash generating unit, so first of all, we have to hit the goodwill. We have to finish the goodwill, right? If still any impairment loss is remaining, if the balance is there, we have to allocate the balance impairment loss in the ratio of the assets, right? Like in the case of case 1. Okay, so what we have done, we have allocated this 10 million in the ratio of 3:2:2. Okay, so we have allocated in the ratio of 3:2:2. Okay, but if in a cash generating unit, if any asset is having a value which is more than the recoverable value, or let's say if the recoverable value is more than the carrying value, then impairment is not required to be charged on that particular asset, and impairment is required to be charged on the remaining asset in the pro rata basis. Right? I hope it is clear to everyone now, guys. let me put some case study here from the institute study material. Yeah. So we discussed this, the impairment loss should be allocated to reduce the carrying amount of the asset of the CGU in the following order. First, reduce the carrying amount of goodwill allocated to CGU, then to the other assets of the CGU on the pro rata basis, right? In allocating an impairment loss, an entity should not reduce the carrying amount of an asset below the highest of fair value less cost to sell or value in use. It is a recoverable value. Okay. So if an asset is having a recoverable value which is higher than the carrying value, so impairment loss should not be charged on that asset, right? Clear? Now quickly do this case study. Illustration number 20. XYG Limited has a cash generating unit, plant A. So this plant A is a CGU. As on 1st April 2001, having a carrying amount of 1000 crore. The carrying value is 1000 crores, right? Plant A was acquired under a business combination and goodwill of 200 crore was allocated to it, right? So plant A was acquired under a business combination. This plant was acquired as a business combination. Goodwill of 200 crore was there in the plant. It is depreciated on a straight line basis. Okay, the carrying value of the plant is 1000 crores and goodwill of 200 crore was allocated. Plant A has a useful life of 10 years with no residual value. If useful life is 10 years, then what is the depreciation? 100 crores every year. On 31st March 2002, plant A has a recoverable amount of 600 crores. Okay. So there is a plant, and if you see this plant, the goodwill is 200 crore in this plant, which is CGU, and the plant is 1000 crore. The total value is 1200 crores, right? The total value is 1200 crores. And it is talking about 1st April 2001, and it is talking about on 31st March 2002, that is after end of 1 year. So if I talk about this CGU, the assets of the CGU was acquired like plant and goodwill. 1000 crore of plant was there, 200 crore of goodwill was there, total was 1200 crores. There was a depreciation of 100 crore was there, and at the end of the year, right? So 900 crores is there, and here 200 crores is there. So at the end of the year, 1100 crores is there. 900 your plant value and 200 crore goodwill value. And against this 1100 crore, what is my recoverable value? My recoverable value is 600 crores. My recoverable value is 600 crores, right? So how to allocate this impairment loss? So first of all, if you see this, the carrying value is goodwill is 200, 900 is plant, and total is 1100. So guys, here CGU is there, plant, goodwill 200, plant 900, and there is an impairment loss of 500, right? So impairment loss of 500, this has to be allocated. How this has to be allocated? This goodwill has to be entirely strike off, and the remaining balance will charge off with the plant, right? So 200 million goodwill has been charged off, so this goodwill becomes 0. 900 minus 300, the balance impairment loss goes to plant, it becomes 600, it becomes 600. So the goodwill will become 0 and the value, revised carrying value of the plant is 600 million, right? Any doubt here? Any problem? Any doubt so far? Yeah. Is it clear, guys? Is it clear? Yeah, good. Let's do this case study. Just skip, because I have already taken this case study of corporate assets. So this will be your homework. Now coming to the last concept of the day, which is reversal of impairment loss. So guys, so far we have discussed the recognition of impairment loss. Now we need to discuss the reversal of impairment loss. So when an impairment loss can be reversed? When an impairment loss can be reversed, right? So let me just a minute. Let me put my one slide here. Yeah, reversal of impairment loss. First of all, there are two kind of reversal of impairment loss on goodwill and other assets. Whether reversal of impairment loss on goodwill is permitted? Answer is no, not allowed. Reversal of impairment loss on goodwill is not allowed. Reversal of impairment loss on other asset is allowed if there are favorable indicators of impairment. There are favorable indicators of impairment. There are favorable indicators. For example, we have seen there was a external indicator. There was an external indicator which talks about increase in interest rates, right? When interest rate was increasing, your value in use will go down. But when interest rate is decreasing, in that case, your value in use will go up. So this is a favorable external indicator. This is a favorable external indicator, right? This is a favorable external indicator. For example, we have seen that government has come up with a negative announcement that diesel car will ban in Delhi. So it is a negative announcement. It is an indicator of impairment. But when government has come up with an announcement that we are taking back this decision, this is a favorable outcome, right? And hence the value will go up, right? So when there is an external or internal indicator which are favorable indicator, in that case, the impairment loss which have been charged can be reversed. Okay. The impairment loss can be subsequently reversed, right? To what extent impairment loss can be reversed, we will discuss, but impairment loss can be reversed. Whether impairment loss on goodwill can be reversed, answer is no, it is not allowed. So impairment loss recognized in prior period should be reversed when there is an indication that such losses does not exist any long, right? Right. Okay. And when I'm talking about external indicator, internal indicator, it is just reverse of what we have read and understood in case of indicator of impairment, right? So coming to the reversal of impairment loss on individual asset. So reversal of an impairment loss shall not exceed the carrying amount that would have been determined had no impairment loss been recognized for the asset in prior years, right? Reversal of an impairment loss for an asset other than goodwill shall be recognized immediately in profit or loss. Any reversal of an impairment loss of a revalued asset shall be treated as a revaluation increase in accordance with other Ind AS. Further depreciation will be charged on revised carrying amount. Sir, what is the meaning of these things? What is the meaning of these items? See, let me put my Excel file and let me talk about the reversal of impairment loss, right? Reversal of impairment loss. Reversal of impairment loss on goodwill is not allowed. Reversal of impairment loss on goodwill is not allowed, right? Reversal of impairment loss on other asset is allowed if there are favorable indicators, right? Now, how much impairment loss can be reversed, right? So first of all, let's take a scenario where cost of asset is 100 rupees, is let's say 1000 rupees. So life is, let's say, 5 years, right? And WDV at the end of year 2 will be, if life is 5 year, what is my depreciation per annum? My depreciation will be 200 per year, 200 per annum, right? And what is the WDV at the end of year 2? 1000 minus 200 multiplied by 2, 600 is WDV. And there was an impairment loss. There was an impairment loss at year 2, at the end of year 2. And this impairment loss was again 200 rupees, for example. Or let's say this impairment loss was 300 rupees, right? So what is my revised, what is my carrying value? Because the formula of carrying value is cost minus accumulated depreciation minus impairment losses. So carrying value is equal to cost minus accumulated depreciation minus accumulated impairment losses. So this comes out at, my carrying value comes out at 600 minus depreciation minus impairment 300. So this comes out at 300, right? 300. So now what is my carrying value at the end of year 3? At the end of year 3, my carrying value will be 300. So my carrying value at the end of year 2 was 300. And what is my depreciation for year 3? What is my depreciation for year 3? Depreciation for year 3. The depreciation for year 3 was 300 divided by 3. 100 rupees. What is my carrying value at the end of year 3? My carrying value at the end of year 3 is 300 minus 100. Right. What is my carrying value at the end of year 4? What is my carrying value at the end of year 4? At the end of year 4, my carrying value was what is the depreciation at the end of year 4? Of course, it is 100 rupees, na? It is same. 300 divided by 3, it is same, right? So my carrying value at the end of year 4 is 100 rupees. Is 100 rupees. And at the end of year 4, at the end of year 4, there was a favorable indicator, and the value has gone up to, let's say 180. The value has gone up to 180, right? The value has gone up to 180. Okay. So what is the recoverable value? The recoverable value is 180. The value has gone up to 180. And the standard says that in this case, my carrying value at the end of year 4 is 100. And at the end of year 4, there was a favorable indicator and this value will become 180. So how much impairment loss can be reversed? Is it 80 rupees or something else? Standard says that for reversal of an impairment loss, how much reversal of an impairment loss will be there? So standard says that after reversal of an impairment loss, the carrying value, the revised carrying value should be lower of, the revised carrying value should be lower of recoverable value, which is 180, in this case, and had the asset never been impaired, अगर ये asset कभी impair नहीं हुआ होता, had the asset never been impaired, then what would be the carrying value? Carrying value. Had the asset never been impaired, then what would be the carrying value? So Jay, if the asset had never been impaired, then what would be the carrying value at the end of year 4? Tell me. at the end of year 4, if the asset would never be impaired, then what would be the carrying value? Simple. What was my cost? My cost was 1000 rupees. What is my depreciation for 4 years? My depreciation for 4 years would be 200 multiplied by 4. Okay. So my, had the asset never been impaired, my recoverable value is 180. My carrying value would have been 200. My carrying value would have been 200. Okay. So what is lower? So lower is 180. Lower is 180. So in this case, my cost of the asset, my carrying value of the asset is 100 rupees. So I have to increase how much value? I have to increase the value to the extent of recoverable value only, which is lower. Okay, which is 180. What is the accounting entry? The accounting entry is asset account debit to impairment loss reversal. To impairment loss reversal. Right? To impairment loss reversal. So 180 minus 100. 180 minus 100. So let me write here. So in this case, the revised carrying value should be 120, which is lower of 180 and 100, which is 120, which is 180, right? So asset account debit 180 minus 100 to impairment loss reversal credit, which is 80 rupees. I hope it is clear to everyone, friends. I hope it is clear to everyone. So this is the concept. After reversal of impairment loss, the revised carrying value should be lower of recoverable value, and had the asset never been impaired, then what would be the carrying value? Sir, here if the recoverable value was 250 and the carrying value would have been is 200, then in that case we will take 200, right? We will take 200. Is it clear? Is it clear? Yeah. So Sairam, yes, if there is a physical damage to the asset, it is an internal indicator of impairment, right? I hope it is clear to everyone, friends. I hope it is clear to everyone. So now let's go back to the PPT once again. Reversal of an impairment loss shall not exceed the carrying amount, that would have been determined had no impairment loss been recognized for the asset in prior years. So it is lower of recoverable value and carrying amount, right? Reversal of an impairment loss for an asset other than goodwill shall be recognized immediately in profit or loss. But if there is a revaluation model, so this is in the case of cost model. But if there is a revaluation model, the company has opted a revaluation model on any asset. In that case, if there is any reversal of an impairment loss, so you have to treat in accordance with that Ind AS, right? For example, whatever impairment loss you have booked, to that extent it will go to P&L. Over and above will go to OCI. And further depreciation will be charged on revised carrying amount. So in the next year, in the 5th year, the depreciation will not be on the 100 rupees, it will be on 180 rupees. So in the next year, the depreciation will be 180 rupees, right? Coming to CGU, impairment loss recognized for goodwill should never be reversed in a subsequent period. We have discussed that the impairment loss on goodwill is not allowed to be reversed. The reversal of an impairment loss for a CGU should be allocated to the asset of the CGU, except for goodwill pro rata with the carrying amount of those assets. Apart from goodwill, whatever impairment loss reversal is there, it has to be reversed pro rata to other assets of the CGU, right? Such increase in carrying amount shall be treated as a reversal of impairment losses for the individual assets. Okay, simple. And in allocation of reversal of an impairment loss for a CGU, the carrying amount, the revised carrying amount shall not be increased above the lower of recoverable amount and carrying amount. Same, which I have explained you in the Excel file. So basically, it is not only for CGU, it is for everything. It is for the asset, it is for the asset under CGU. The revised carrying value will not be exceed beyond recoverable value or Had the asset never been impaired, then what could be the carrying value, right? Okay, understood. So you have to see this threshold so that the balance should not be increased beyond recoverable value or beyond carrying value, which would be there had the asset never been impaired. I hope it is clear to everyone, guys, so far. Yeah. So let me discuss this illustration number 10, which is a very, very critical and very good illustration. On 1st April 2001, Venus Limited acquired 100% of Saturn Limited for rupees 4 lakhs. Okay. The fair value of the net identifiable asset of Saturn Limited was 3,20,000 and goodwill was 80,000. So this is a business combination, and on 1st April 2001, this company has acquired 100% of another company for rupees 4 lakh. The fair value of tangible asset was 320 and goodwill was 80. Saturn Limited is in coal mining business. On 31st March 2003, that is after 2 years, the government has cancelled licenses given to it in the few states, right? So government has cancelled the licenses. As a result, Saturn Limited revenue is estimated to get reduced by 30%. This is a negative indicator of this is an indicator of impairment, and its revenue reduced by 30%. Adverse change in marketplace and regulatory condition is an indicator of impairment. As a result, Venus Limited has to estimate the recoverable amount of goodwill and the net assets of Saturn Limited on 31st March 2003. Venus Limited uses straight line depreciation. The useful life of Saturn Limited asset is estimated to be 20 years with no residual value. So we are talking about after 2 years, and the value was 3,20,000 and the useful life is 20 years. So 2-year depreciation has to be there. 320 divided by 20 multiplied by 2, right? So roughly 64,000 depreciation will be there. No independent cash inflow can be identified to any individual asset. So the entire operation of Saturn Limited is to treat it as CGU. So this entire operation of 3,20,000 plus 80 has to be treated as CGU. Due to the regulatory entangle, it is not possible to determine the selling price of Saturn Limited as a CGU. Its value in use is estimated by the management at 2,12,000. So fair value is not possible, but value in use is 2,12,000. So on 31st March 2003, the value in use, the recoverable value is 2,12,000. So in the question, one information is given that VIU is 2,12,000, right? And CGU value is 4 lakh also given in the question. And out of this 4 lakh, 80,000 is goodwill and 3,20,000 is the net identifiable asset, right? Suppose by 31st March 2005, the government reinstate the license of Saturn Limited, right? So now after 2 years again, so it was 1st April 2001. After 2 years, on 31st March 2003, there was a negative indicator, and the value, the revenue has been reduced, and the value has been 2,12,000, right? So we have to calculate the carrying value as on 31st March 2003. Then we will assess whether my carrying value is higher or lower than the recoverable value. If my carrying value is higher than the recoverable value, I have to book an impairment. Now again, after 2 years, there is a positive news. By 31st March 2005, the government reinstated the license of Saturn Limited. The management expect a favorable change in net cash flow. This is an indicator that the impairment loss may have reversed, and the recoverable amount of Saturn Limited net asset is re-estimated. And now the value in use is expected at 3,04,000, and fair value less cost to sell is expected to be 2,90,000. So what is my recoverable value? Higher of value in use and fair value less cost to sell. So 3,04,000, which is higher than 2,12,000, which is given. Calculate the impairment loss, if any. Also, you are required to show the accounting treatment for reversal of impairment loss and the subsequent depreciation thereof. So first of all, since the fair value less cost of disposal is not determinable, the recoverable amount of the cash generating unit is its value in use, which is 2,12,000. The carrying amount of the CGU on 31st March 2003 is as follows. 80,000 is a goodwill value. Other assets 3,20,000. The total value is 420, right? And what is the accumulated depreciation? 3,20,000 divide by 20 multiply by 10, right? Multiply by 10. So what is my per annum depreciation? My per annum depreciation is 16,000. So total depreciation is 32,000, right? So the carrying value as at 31st March 2003 is 80,000 for goodwill, 2,88,000 for other assets, and 3,68,000 for total assets. Now, what is the recoverable value? What is the recoverable value? So carrying value minus recoverable value is equal to impairment loss. My carrying value is 3,68,000. My recoverable value is 2,12,000. So 1,56,000 is my impairment loss. So first of all, out of 1,56,000, straight away, I have to hit goodwill. I have to charge goodwill entirely, 80,000. And the remaining 76,000 will go to the other assets, right? Now, what is my revised carrying value after impairment loss on 31st March 2003? On 31st March 2003, my revised carrying value is goodwill 0 and other assets is 288 minus 76 comes out at 2,12,000, right? This is my revised carrying value. Is it clear? And this entire 1,56,000 will go to the P&L because no information relating to revaluation has been given in this question. So impairment loss is equal to carrying amount minus recoverable amount. 368 minus 212 is charged in statement of profit and loss for the period ending 31st March 2003 as impairment loss. Impairment loss is allocated first to goodwill and the remaining loss of 76,000 is allocated to other assets. Now on 31st March 2003, the revised carrying value is 2,12,000 and the remaining useful life is 18 years, right? Now I have to charge depreciation every year to the tune of 2,12,000 divided by 18. Historical cost is 3 lakh. Now, after 2 years, I have to, that after 2 years on 31st March 2005, there was a positive indicator of impairment and the recoverable value becomes 3,04,000. So now what we are required to do, we have to, recoverable value is there, we have to compute revised carrying value. Had this asset never been impaired, what is the revised carrying value? So in this case, my historical cost was 320. Had this asset never been impaired, my yearly depreciation was 16,000. So my 4-year depreciation was 64,000. So if this asset had never been impaired, then my revised carrying value would have been 2,56,000, which was 2,12,000 prior to 2 years, right? So this is the revised carrying value which would have been there if it was never any impairment. And what is my recoverable value? My recoverable value is given as 3,04,000. 3,04,000. So which is lower? 256 or 3,04,000? 256 is lower. So we have to reverse an impairment loss in a manner that it will not go beyond 2,56,000, right? And what is my carrying amount as on 31st March 2005? So as on 31st March 2003, the revised carrying value was 2,12,000 and remaining life was 18 years. So when you divide 212 divide by 18 multiply by 2, it will comes out at 24,000 approximate. So your carrying value as on 31st March 2005 is 1,88,000. And after reversal of an impairment loss, the maximum amount could be 2,56,000. So what is my reversal of an impairment loss? The impairment loss recognized previously can be reversed only to the extent of lower of re-estimated recoverable amount or the carrying value which would have been there if there will never be an impairment. So it is 2,56,000 or 3,04,000, whichever is lower. So it is 2,56,000, right? So impairment loss reversal will be 256 minus 188, 68,000. This will be the impairment loss reversal. So after reversal, my revised carrying value will be 256 and remaining life is 16 years. So going forward, this depreciation has to be computed on the basis of 2,56,000. So from 1st April 2005, the depreciation charge will be 256 divided by 16, which is 16,000. So my revised carrying value will become 256 and the depreciation will be charged on the basis of 256 over a period of 16 years. I hope it is clear to everyone, friends. Friends, let me know if you have any doubt on the reversal of impairment loss. Let me know if you have any doubt on the reversal of impairment loss. Disclosure, I am not covering. Disclosure is not relevant. This is just, I have included in my PPT. This is not important, right? So let's summarize the lesson summary. So we have discussed the objective and scope of Ind AS 36. We have discussed that we need to identify an asset that may be impaired. So if indicator impairment is there, then we need to say that we need to perform an impairment testing. But there were three assets where indicator of impairment is not that important. Goodwill acquired in business combination, intangible asset having indefinite useful life, intangible asset not yet available for use, right? In these three cases, you have to perform an impairment testing at least once in a year. Then you need to measure recoverable amount, which is higher of fair value less cost to sale and value in use. So fair value less cost to sale, fair value has to be determined as per Ind AS 113. Cost to sell is an incremental cost which is there due to the decision which has been taken for a sale, right? Value in use is a present value of future cash flows. So discount rate and estimation of future cash flows is very important. Then we have discussed recognition and measurement of impairment loss. If the entity is opting for a cost model, then impairment loss has to be charged to the P&L. But if the company has opted for a revaluation model, so in that case, if earlier there was an increase due to there was an increase in a revaluation surplus which was into OCI, so this impairment loss has to be adjusted with the OCI, and still if the impairment loss is there, it will go to the P&L. So technically speaking, the concept of Ind AS 16, Ind AS 38 will, or Ind AS 40 will follow, right? Concept of CGU we discussed with the example of a bus company and example of 3 machines. So cash generating unit is the smallest identifiable group of asset which can generate cash flow independently. The cash generating unit can be identified on the basis of it should be capable of generating cash flow. It is important that how management is monitoring operation, and it should be consistent from one period to another, right? Then we have discussed that goodwill has to be allocated on all the cash generating unit which is getting benefited from the acquisition. The corporate asset has to be allocated in the ratio of the CGU values, and then we need to compare the recoverable value of the CGU after including the corporate asset, and then if the impairment is there, we have to allocate the impairment in the CGU and the corporate asset in the ratio of their carrying value. Then we have discussed the allocation of impairment loss in corporate asset and cash generating unit. If there is a cash generating unit, if there is an impairment loss, you have to strike off goodwill first. If the balance loss still remains, you have to allocate the impairment loss pro rata on the basis of the carrying value. If a particular asset has a recoverable value which is more than the carrying value, in that case, impairment loss is not required to be charged on that particular asset. In the case of reversal of impairment loss, we have discussed reversal of impairment loss on goodwill is not allowed, but for other asset it is allowed if there is a favorable indicators. And the reversal of impairment loss should not go beyond the re-estimated recoverable value, and had the asset never been impaired, what would be the carrying value? So it will not go beyond the lower of these two values. Okay. Sairam is asking, sir, what if in the balance sheet there was other intangible asset other than goodwill? Then how the impairment loss will be allocated? Sairam, if you can see the software example, if you can see the example on Excel file, let me put my example on Excel file. Sairam, if you see this example where I have taken an example of allocation of impairment loss on CGU, so you can see that I have taken one intangible asset also, which is software. The other intangible asset, impairment loss on other intangible asset has to be charged pro rata, okay, like tangible asset. Okay, Sairam. Guys, I hope you are able to understand the concept of impairment of asset in the last 2 days, including today. I have taken a lot of layman language examples, a lot of case studies I have discussed, a lot of things on Excel file I have discussed. I have put a lot of classworks, and I have also taken so many case studies from institute study material. And as far as your homework is concerned, you have to take each and every case study from ICAI study material and RTP. And let me tell you, if you will cover the entire study material and RTP, so probably as far as concept is concerned, in examination, nothing will come beyond that. That I can assure you as far as concept is concerned, right? I hope it is clear to everyone, guys. Let me know if it is clear to everyone, so I can conclude the session. And happy Ram Navami to everyone. Happy Navami to everyone. Stay safe, stay happy, and stay healthy. Thank you so much. I hope you have enjoyed the session, and I hope you have understood the session. Thank you so much, guys. Bye bye. Take care.